Hi, everybody, and welcome back to video number 3 in chapter 12. And when we left off, we were looking at vacation pay. And here's an illustration. We're going to assume that Pupjoy began operations on January 1, 2025. The company employs 10 individuals and pays each $480 per week. The employees earned 20 unused vacation weeks in 2025. In 2026, the employees used the vacation weeks, but now they each earn $540 per week. Pupjoy accrues for vacation pay accrued in and paid in 2026 as follows. On December 31st, 2025, it records the accrual of vacation pay as follows. We're going to show 20 weeks here at $480 per week. So that's going to be salaries and wages expense, $9,600, and the credit is going to be to salaries and wages payable, $9,600. Okay, now when we pay the vacation pay in 2026, we're going to make the payable go away, zero it out with a debit for $9,600 to salaries and wages payable, and we're going to create an additional $1,200 of salaries and wages expense and credit cash for $10,800, which is, going back here, the $540 per week times 20 weeks. Okay. Sick pay. If sick pay benefits vest, meaning that the employee is now entitled to it, a company must accrue them. If sick pay benefits accumulate but do not vest, a company may choose whether to accrue them or not. Okay, bonus agreements. Here, payments to certain, or in some cases, all employees in addition to their regular salaries and wages. Bonuses paid are an operating expense. No surprise there. Unpaid bonuses should be reported as a current liability. Let's take a look at an example. Palmer Incorporated shows income for the year of $100,000. It will pay out bonuses of $10,700 in January 2026. If Palmer makes an adjusting entry dated December 31, 2025 to record the bonuses, they will do it as follows. We're going to debit salaries and wages expense for $10,700 and credit salaries and wages payable for $10,700. In 2026, it records the payment of the bonus as follows. We're going to debit salaries and wages payable. That will zero out that liability and credit cash of $10,700 to pay for it. Okay, here we'll put into practice. Presented below are selected transactions of Bonanza Corporation for the current month ending December 31. 1. On December 1, it borrowed $90,000 by signing a $90,000 8% 6-month note. Number 2, Bonanza uses the perpetual inventory system and the gross method of accounting for purchase discounts. by far the most common way that companies account for these kinds of things. On December 2, Bonanza purchased $40,000 of inventory items, terms 210 net 30, FOB shipping point. So if it's FOB shipping point, that means that Bonanza is responsible for the inbound freight, and that freight is going to be recorded to inventory, not to shipping expense. On December 10th, Bonanza paid for the goods and related freight costs of $1,200. Okay, number 3, an additional fact. During December, cash sales totaled $800,000. A 5% sales tax on these sales, collected in addition to the $800,000, must be remitted to the state by the 15th day of the following month. Number 4, for December, gross salary and wages totaled $100,000. All earnings are subject to the 7.65% FICA taxes, 4% state unemployment tax, and a 0.6% federal unemployment taxes. Income tax withholding is $18,000. In addition, it's determined that it owes employees $6,000 in accrued vacation wages. All right, so if we issue the notes payable, we're going to receive the cash, $90,000, and credit the liability, notes payable. Go back here, and that's number 1. Number 2, interest expense. We are going to take 90,000 times 8% times 1 month for December and record interest expense, but we haven't paid for it yet, so that's going to be another liability called interest payable to record the interest for the month. Then, as we purchase the inventory, we'll debit inventory for $40,000 and credit accounts payable to pay for that eventually to our vendor. And then when we actually do pay our vendor, we'll zero out the accounts payable for $40,000 and credit purchase discount for $800 and credit cash for $39,200. So we took the terms of 2% net 30, I believe it was. Okay. Now the freight costs, again, we're going to debit inventory, $1,200, and credit cash to pay for it, $1,200. When we record, this is important, so be sure when you're doing freight costs, you remember the inbound freight for inventory gets debited to inventory, not to a freight expense account. We have expense accounts for freight, but this isn't where we use them. Okay. So now we'll record the sales tax collected. Here we got a full cash for all our sales, which was $800,000, but we also collected sales taxes. So we'll credit sales taxes payable and eventually remit that to the government. To record the salaries and wages expense, we're going to debit salaries and wages expense for the gross of $100,000, credit withholding taxes payable, $18,000. That's going to be remitted to the appropriate government agency. FICA taxes payable, 7.65% of $100,000. And the resulting cash will be what the employees are going to receive in their paychecks. But we also need to record the accrued vacation pay here. So we'll debit salaries and wages expense for $6,000 and credit salaries and wages payable for $6,000, because the employees have not yet taken that vacation. And not to forget our employer taxes. Here we have payroll tax expense for $12,250. That includes FICA taxes, both FICA Medicare and FICA Social Security, as well as FUTA taxes and SUTA taxes. All right, now we'll move to learning objective 2 here. We'll describe the nature, valuation, and reporting of current liabilities in the form of unearned revenue. Now, normally this is an easy one to remember because if we get paid in advance for something that we have not earned, it's going to be unearned and we will have a liability to perform those services or provide those products. So, some examples of that are here. A magazine publisher such as Condé Nast receives payment when a customer subscribes to the New Yorker. An airline company, such as American Airlines, sells tickets for future flights. And software companies like Microsoft issue coupons that allow its customers to upgrade. So all of that, we have unearned ticket revenue, unearned subscription revenue, unearned rent revenue, and unearned gift card revenues. Those all become liabilities until we actually deliver our passenger to its intended destination, provide the subscription to the magazine that was ordered and paid for in advance. The hotel, we actually stay at the hotel and earn that rent revenue. And finally, our retailers here, same kind of thing for the gift card revenue until they're actually used. Okay, let's look at an example for Allstate University. And it sells 10,000 season football tickets at $50 each for its 5-game home schedule. Its first game is going to be played on September 7th. The following entries are going to be made on August 6th. So all of this, $500,000, is unearned. We do receive the cash, so we debit cash, but we credit unearned ticket revenue, a liability for $500,000. Now, actually, after the first game is over, all that, the 1/5 of that $10,000 or $2,000, 2,000 seats, tickets, is going to be earned. So when we earn that, we now have earned 100,000 sales revenue and will reduce the liability of 500,000 down to 400,000 by debiting unearned ticket revenue for $100,000. Gift cards. These little beauties are used by companies to attract new customers and improve sales. When Amazon sells you a gift card, it is receiving a non-refundable payment for goods and services that your gift card recipient will have the right to in the future. So here in March 2025, Haven Retailers sells 10 gift cards at $200 per gift card, or $2,000, 10 times 200. In April 2025, 6 of the gift cards are redeemed. Haven estimates that the cost of goods sold will be 70% of the sales price, or $140 per gift card. The remaining 4 cards are expected to be redeemed in May, and then thus 60% of the revenue is recognized in April, 40% in May. The following entries should be recorded when the gift cards are issued and redeemed. And we'll have to wait to see that until the next video. Until that time, bye for now.